Hello, MIINT participants. My name is Jacob Gray, and I am the Senior Director of the Wharton Social Impact Initiative, where I focus on impact investing. Wharton is a partner with Bridges Ventures in producing the MIINT, as you know. A little on my background: I've spent 14 years as an impact investor. I'm co-founder and a partner of Murex, which is an impact venture capital fund headquartered here in Philadelphia, and we invest in technology-based early stage companies in education technology and financial services for the poor. My career started as a strategic consultant to high-growth nonprofits. Over the years, I've served as interim CEO of a social impact company in the workforce development sphere. I've done work in domestic microfinance, and I'm co-founder of Good Company Group, which is an accelerator for social enterprise, among other activities. Now, I should make clear that although I am speaking to you as a part of Wharton, and although the MIINT is about impact investing, this video is not intended to serve as an academic finance curriculum. I hope that's obvious. The course is intended first and foremost as practical training, experiential, co-curricular education on how to participate in the MIINT. To that extent, we will spend very little time on theory and much more on the nuts and bolts of operating a student-involved, in many cases, student-driven impact investment program at your school. With that said, today I'm going to talk to you about deal sourcing. I've broken deal sourcing up actually into 4 segments, which you see listed on the slide ahead of you. Each segment is quite short, so you should be able to watch each easily and separately in a manageable amount of time. So our goal, the goal here is by the end of this session, that means all 4 segments, we want you to be able to articulate your investment strategy and your thesis in writing. Then you should be prepared to actually go out and start finding good deals that make sense for you and your team in a fairly rational and thoughtful and efficient manner. And we'll wrap up the session with a few thoughts on how to actually approach entrepreneurs for the first time so that you can do this with some degree of confidence. Now, to keep things from getting unbelievably boring while you listen to me talk, and for some concrete perspective, I have asked some colleagues to join me to comment on the real world of investment strategy and deal sourcing in impact funds. Nancy, will you introduce yourself first, please?
I'm Nancy Fund. I'm the founder and managing partner at DBL Investors here in San Francisco.
And Owen.
Hi, I'm Owen Henkel. I'm one of the co-directors of the University of Michigan Ross School of Business Social Venture Fund, which is a student-led, student-run impact investing fund.
Thanks, Owen. And Josh.
Hi, I'm Josh McCann. I'm a second-year MBA at Wharton and one of the co-presidents this year of the Wharton Social Venture Fund.
Great. So we'll hear from Nancy and Owen and Josh again in a little bit. But first, let's talk about crafting an investment strategy. So what is an investment strategy? It's a framework. Investment strategies provide the framework required for an investor to effectively evaluate transactions and develop an investment thesis. An investment strategy for a fund is essentially how you think about your fund in relationship to all the deals. Your thesis, on the other hand, is how you think about your fund in relationship to individual deals. All right, and what makes a good investment strategy? First, a good investment strategy will be a guide. It's going to be a guide for deal sourcing and for filtering, and both the investigation and evaluation of deals. Second, it's going to address value creation, how your team and your money will create value in a portfolio company. Last, it will be succinct and focused and easy to understand. It will be brief. Why this emphasis on brevity? Because VC, and particularly social impact VC, is a very relationship-driven marketplace. Your best deals will generally be inbound from referrals. So as you network, when you can be very clear and communicate effectively about what you are trying to find, you give others the opportunity to help you. A good investment strategy not only focuses your thinking, so it also drives more high-quality inbound deals. It's that simple. So what makes an effective investment strategy? So the major factors are the deal size, and both the deal size and your investment size, the industry, type of security, the stage, how you're going to plan for follow-on investments, and liquidity, how you expect to exit. So obviously the MIINT tournament has decided a list for you. These are going to be early stage VC deals. The size of the deal is the size of your investment is going to be $50,000, and the size of the deal itself will probably be less than $1 million. The security is almost always going to be convertible debt, and follow-ons are going to be out of your control because the deal is being funded by a third-party angel who will theoretically manage their own portfolio. But to the extent that your school already has your own fund or you are thinking of building one in the future, the intellectual exercise of creating a strategy is valuable. So it's a valuable exercise because it lays the foundation for the rest of your activities. In a very practical way, your diligence will be better if everyone on your team is quite crisp and clear about how you intend to create value. So here are some example strategies. Some were laid out in the deliverable guidance on the website. I'd recommend that you pause on this point if you haven't already to take a look at some of these examples. Funds should leverage their competitive advantages and institutional knowledge when you're determining your focus industry. So some factors for you to consider are absolutely leveraging your university's key strengths. That means what academic or community or research departments are strengths. Does your school or the university have offices or centers that work heavily with companies in a particular industry? Think about your geography. Is the city a major hub? Are there incubators? Are there other community organizations in your geography that cater to a specific industry? And I think all of this is particularly important in a student-run fund. With less experience and less track record than a traditional fund, you really need to be thinking about your strategy in relationship to this target industry. So the next thing to think about is your team. Many funds build strategy around the industry experience and strengths of their team. Some funds don't. For example, Nancy Fund, who's the managing partner of DBL, highly respected, one of the best, really believes in hiring strong investment generalists rather than industry experts. But for school-based funds, I think it's critical that your team members and your school and your geography strengths all work together. Otherwise, you're going to have a very hard time getting any proprietary deal flow. It's going to be hard to win the MIINT tournament if your school is essentially looking at exactly the same deals with little differentiation from all the other schools. Plus, you might miss some uniquely talented individuals. I'm going to give you a guess about who's circled in red. So you want to consider the security type as well. As I said before, MIINT is going to kind of make up this for you, but there's a self-explanatory kind of primer here. The vast majority of deals you'll see in seed or early stage rounds are convertible debt, converting into preferred equity at a discount to the next round price. And this is simply because investors won't be able to agree on company value with the entrepreneurs, and convertible debt is a nice way to let the company's future performance determine its value. So basics about stage as you think about strategy. You're going to see deals in the startup or first stage, most likely. Maybe some seed investments. They're very tough to do and even tougher to sell to a third-party investment committee, as you will in the MIINT tournament, but it's not impossible. In terms of liquidity events, I think the IPO market still hasn't recovered, so we ought to be thinking about M&A. I guess a good point here is that one of the most powerful ways to leverage your institution strength in your investment strategy is to bring potential M&A partners to the table for portfolio companies. So it's a very real and potentially powerful strategy. And then we'll talk about follow-on strategy just a minute. Take a look here. Again, if you're considering building your own fund, I think the important takeaway here is that because of the powerful dilution involved, many early stage investors consider their earliest investments to be more valuable really just as an option for later rounds. So reserving enough capital for follow-on is really critical. And last, let's talk about value add. MIINT teams are all affiliated with very strong business schools and larger, strong university institutions. You have valuable networks and talented people. These companies, at least most of the good ones, will have choices in whose capital they can take. You want to be sure to be very clear and precise in how you discuss the value you're going to add to these companies so that you can help them make the right decision and take your money. But that's enough of me talking. Let's hear from our guests and hear what investment strategy means to them in the real world. At inception, how did your organization approach framing that successful investment strategy when you were just starting out? And I'll ask Owen to start, if you would.
Yeah, I think that it was really important to think about our stage and what type of social impact was important to us, because I think both those things can be defined broadly. And so what we decided was that it was really important for us to be post-revenue, post-prototype, because we had a little turnover in the fund due to the fact that we're at a university, we didn't have the deep industry expertise to really get the intuition of willingness to pay. So that was something we could definitely miss. Mm-hmm. And so that post-revenue was a very important piece for us. I think sorry?
I said thank you. That's an important piece. I'm sorry to cut you off. Go ahead with the next point.
I think then the second question is just thinking about social and like what counts as social or how direct. And I think another way we like to think about it is that one could think of a lot of things as social, maybe just job creation. It could be very social in the right context. But it seems that, at least for us, we want to focus on things we think are maybe a little bit more directly social, in the sense that that service has a positive benefit built into it, as opposed to just generating positive externalities. So I think that was kind of how we started scoping our investment thesis.
Thanks. And Josh, how about you? And I guess the first question is, you've got an ongoing fund that's been operating with a fair amount of consistency for 3 or 4 years now. So, did you pick up that strategy and reshape it this year? Was the first question.
So we definitely inherited a strategy, and we're quite lucky in that regard. First, an approach to both the social element and also the sort of the financial component of the investment. We inherited a strategy. I think the nature of a student-led initiative at a business school is that those things will be re-examined from time to time, and so we're undertaking an initiative now to sort of reiterate our statement about our focus on social, and we sat down as the executive and sort of re-endorsed the investment strategy that had been sort of pursued previously, and maybe added a little more detail.
Mm-hmm. Okay, excellent. And Nancy, this would have been a few years back. Let's see, what vintage year is the current DBL fund?
Well, we have two. One is 2004, and one is 2010.
Oh, okay. So, well, let's do the 2010. If it's significantly different from 04, I mean, if not, if you can think back to 04, how did you approach framing your investment strategy?
Well, I've been a traditional venture capitalist for most of my career, and so we really, and so have my colleagues, we decided to stick to our knitting and really focus on disruptive new entrants into industries or entrance into whole new industries. But we did want to have that social impact in a variety of ways. We believe that any company can have a social dimension to it, and that when we work with our companies to do that. There are some that are obvious, like clean tech, but we also focus on job creation, not just job creation, but job creation in low-income neighborhoods. We look at place as a tool of social change to expand the entrepreneurial economy into neighborhoods that haven't benefited from that in the past. We look at the diversity of the workforce. We look at where companies are sited, and then we're very devoted to climate change improvement, and so we have a lot of metrics around that. But so that shaped our overarching approach, which was a traditional venture capital approach, looking for companies that start small but have the potential to grow very, very large. Because another facet of our impact is if you're not creating companies that really revolutionize their industry and create a lot of jobs, you're really not having as much social impact.
Mm-hmm. So I'll just follow up with that one. So if you came out of a VC headset essentially about industry disruption, and did you push directly to targeted industries from there, and then did that sort of generate your fund dynamics, size, bite size, how much money you wanted to raise, who you were even going to hire to fill out your management team, et cetera? Or would you do it the other way around? So that's a question students often ask me: is where do you start?
Well, it took us a while to raise the fund because it was post.com back in 2002, 2003. So it was very difficult to raise. We had a target of $75 million to get started, and that's what we did. And our focus was only the Bay Area for that first fund. And I would say that we went in with we're going to be sector agnostic. I've invested over my career in life sciences, clean tech, IT, healthcare, and consumer products. So we felt that we would continue that focus. When we finished fundraising, it was very evident that clean tech was ripe for very solid investing, and so even though we didn't market the fund as having a clean tech focus, by the time we raised it, we did include clean tech because it's an extremely obvious way to fulfill our mission. It creates a lot of jobs. It deals with climate change issues. It's really benefiting from a whole new crop of entrepreneurship. So even though we didn't lead with that, we incorporated it. And I had some previous experience in that sector earlier. So
and did that have any impact on how you sourced other professionals in your or advisors for your fund?
It didn't. We really focused on investment expertise because I had some domain expertise from having been in the business a long time and done some clean tech investments. But when all is said and done, what you really need are people that have good investment instincts and disciplines, and then you can grow the rest of that part of the equation. You can grow industry expertise. You can grow the social dimension as well.
Yeah, thank you. And I'll go to you. I mean, when you were crafting your thesis, did you start from the students who were interested, or did you go the other way around where you said, well, we've got a thesis here, and rather we're going to find students who know about ed tech, and we want to bring them into the fund?
Yeah, so I think when we first came up with our investment thesis in our areas, it was actually kind of a perfect mix because we have a lot of dual degree students. So we kind of have a dual degree with the School of Natural Resources. It's called Urban. So there's a lot of people with clean tech backgrounds. And there's also a lot of dual degree students from the public health school and then the education school, like myself. And those also happen to be kind of industries where there's a lot of disruptive new businesses entering, and that seem to be, at least in some senses, inherently social. So those seem to be like kind of good places for us to focus broadly. And then finally, because we're very close to Detroit, and we're kind of Michigan is a big part of the entire business school's focus, we also want to focus on urban revitalization issues, but more specifically in Detroit, or the Detroit metro area. So I think that final area was more kind of an issue of proximity. But in a funny way, it actually really worked out that a lot of the existing expertise that was for some of the opening students also overlapped with some interesting industry areas.
Mm-hmm. So same question, Josh. Was there any inductive dimension to fund strategy?
So I think relatively similar to what Owen outlined. We're lucky enough to have the healthcare management program and a strong cohort of education-focused students. And those businesses are inherently social in a lot of instances. They achieve a lot of good and are focused on the sort of areas that we care about. So that lines up pretty well with sort of, and so that's 3 of our 6 sector teams are in the healthcare education space. And then on the fund strategy about investable assets is sort of driven to a large extent by we want to deliver the best experiential opportunity to our student members, but we also, to do that, we need to be valuable. And the place on the value chain we think we're valuable is in that early stage companies. We have free labor, and so we can do a lot of sourcing, we can do a lot of diligence work, and we can help small companies that are raising their first external money, or raising external money for the first time, sort of go through that process. We can help progress them along. So that was, that's where we thought our members would have most value add to the people we wanted to be working with. And so that's how we ended up in that sort of space with that focus, I believe.
Okay, all right. So just to pull that out a little bit, you're saying that you had decided that the $50,000 ticket size of the Wharton Social Venture Fund was not going to be the biggest value add. That the bag of money, in other words, was not the biggest value add, but it was rather some of the sector expertise of the teams. Am I getting you correctly?
I mean, we're not understating the value of the money. I think that obviously people like the fact that we have money, and that's how we get to be at the table. However, on top of that, there are people like Nancy with 30 years experience who are would be a much more valuable name to have in your round. We're lucky, I'm sure, the other schools participating are lucky that we can leverage the school's brand, and that's pretty valuable. And we found people are really receptive to talking to us on the back of the fact that it's the Wharton Social Venture Fund. If we knocked the Wharton off the front and it was a bunch of, I think, we'd get a lot less traction. And so that definitely helps. But the other thing is, where are we going to add some value? Well, once we're part of your team, we come with a level of staffing and available man hours that probably aren't really, they're not industry standard. And I think that's somewhere we can add a lot of value.